Swayam Prabha. Digital India. Educated India.
Hello everyone. Today's topic is risk assessment in real estate investments as part of the course Real Estate Finance and Investment Strategies. So in this particular class, we will be talking about assessment of risk related to real estate investments and how it can be done. So first, about the learning objectives. By end of this session, you will be able to understand fundamental concepts of risk in real estate investment, identify and analyze different categories of real estate risks, apply quantitative techniques for risk assessment and measurement, develop effective risk mitigation strategies, and evaluate risk return relationship in Indian real estate markets. Now, defining real estate risk. So, what is risk in real estate? Right, that is the fundamental question. So, let's first understand the definition. Risk in real estate investment is the potential variability in expected returns due to uncertainty in future outcomes. So, this definition might sound similar to other asset classes, but real estate has several unique characteristics that makes risk assessment particularly complex. Now, first is immobility. So, we cannot relocate our property. So, they are fixed at one place. So, if you invest in Mumbai office building and the Bandra Kurla complex market softens, you cannot move the asset to Gurgaon, where conditions might be better. This creates concentration risk that must be carefully managed. Then second, we have heterogeneity. So, each property is unique. So, we have discussed this earlier that even in one single building, two flats are not alike. So, one might be on ground floor, another might be at the top, or there can be a situation that on the same floor, one is facing sea and the other one is not. So, these kind of differences can be seen even in a single building. So, you can imagine that when outside a particular building, there can be so many differences between the real estate. So, it is not homogeneous, it is heterogeneity which is the key here. Then high capital requirements, of course, the investments which are going, the amount of money which is being invested in real estate is very high. Then illiquidity, we have discussed this, that it is difficult to convert into cash quickly. There is no market where you can go and sell your real estate like share market immediately. So, you will have to wait. And then long investment horizon, that there is a long period. So, all these things make the risk of real estate unique. It is not something which is, these points have been discussed again and again, but here you have to look at these points through the risk point of view, that all of them are adding risk of the real estate investment. Then risk versus uncertainty. So, risk is measurable probability, whereas uncertainty is something which is unknown. So, unknown probability. So, risk is something which we are trying to measure. So, it can be quantified. Uncertainty, it cannot be quantified. We do not know what will happen, what not will happen. Future is very uncertain. Nobody imagined the one-off event like COVID-19. Then risk can be priced into decisions. So, there are so many risks which are there at a particular moment, which we can actually assess, and then we can bring it in our assessments which we can quantify. But uncertainty requires contingency planning. So, uncertainty, there can be so many types of uncertainties, and at best what we can do is we can plan for them. But in terms of quantification, we can quantify a risk, but uncertainty is something which is we can only prepare for it. So, example, 5% probability of vacancy, we can estimate that. The reason we might not know, but we can always imagine that there is a probability of 5% of vacancy, or maybe 10%, maybe the occupancy dipping to 90%. So, there can be so many things, and there can be impact of unconfirmed metro line, which is not in our hand, which is something government driven. So, there can always be uncertainties. And then what will be the professional approach? Use mathematical models for quantifiable risk and apply judgment and experience for uncertain elements. So, basically quantitative and qualitative aspects. Risk is basically looking at this problem through quantitative assessment, and uncertainty is through qualitative aspects. Then risk return spectrum in Indian real estate. So, we understand that there has to be association of risk with return, and so at the lower risk, lower return end, we find core investments like grade A office building in established location such as Mumbai, maybe BKC, or Gurgaon Cyber City. These typically target return in the 7 to 9% range, but offer great predictability through long term leases with high quality tenants and stable market fundamentals. Then we look at the moderate risk, moderate return category. So, we see value add residential developments in tier 1 city, suburbs, and emerging commercial markets. So, these investments typically target return in the 10 to 14% range, but require active management and face greater market timing risk. At the higher risk, the higher return end, we find opportunistic investment like speculative land acquisition in growth corridor or distressed asset acquisitions. So, these can target return of 15 to 25% or higher, but they face significant execution risk, regulatory uncertainties, and market time challenges. So, it is important to note that these risk return relationships are not static, they shift based on the market cycles, they are dependent on capital availability and regulatory change. For example, the introduction of RERA has generally reduced information asymmetries, somewhat compressing the risk premium in residential development investment. So, the key principle is that higher expected return must be justified by commensurately higher risk. There are no free lunches in real estate investing. Then we move to evolution of risk assessment in India. So, before 2016, much of the industry relied on intuition based approaches with limited formal risk analysis. Decisions were often made based on relationships, market feel, and informal information networks. Due diligence process were less standardized and transparency was limited across the ecosystem. Now, this changed post RERA, right? Post RERA implementation in 2016, we have seen a fundamental shift towards sophisticated institutional quality risk analysis. Several factors have driven this change. So, first, greater transparency and accountability. Now, there is mandate by RERA that developers have to inform and update with the developments in the project, which brings transparency. Then there is much more accountability to their actions. They are in front of RERA for any wrongdoings. So, that kind of accountability has now been generated. Then institutional investor standards are now being coming up, these investors who are not only from outside India but from India also, they are employing all kind of sophisticated mechanisms like maybe like Monte Carlo simulations, comprehensive sensitivity analysis and formal scenario modeling techniques that were rare in the Indian market just a decade ago. So, this evolution continues as market matures and investor sophistication increases. So, for any student who is interested in this area and is entering in the market today, understanding both traditional relationship based approaches and modern analytical techniques is very valuable, right. So, think about that from that way, this particular way. Then we have fundamental market risk factors. So, let us examine the core category of market risk that affect all real estate investment. These systematic risks cannot be eliminated through diversification and must be carefully analyzed for every investment. So, we have economic factors form the foundation of market risk. We have GDP growth correlation is particularly strong in India, where real estate performance closely track broader economic cycles. We have employment trends drive both residential and commercial demand. The growth of India's IT sector, for example, has been a major driver of office demand in cities like Bengaluru, Hyderabad and Pune. Interest rate environment affect both development financing cost and buyer purchasing power, creating multiple transmission channels to property values. Then we have supply demand dynamics represent another critical risk category. We have new supply pipeline analysis which helps predict future competition and potential oversupply situation. We have absorption rate trends indicate market velocity and pricing power, and we have vacancy trends analysis providing early warning indicators of market softening or tightening. Then we also have regulatory environment. We have discussed this, that there can be policy changes. We have RERA implementation which has happened and it is gradually improving over the period of time. And then we have zoning modifications which are there. So, the zones, the master plan and everything, we should be aware of that. So, they can also impact the value of property, the use of property, how people are interacting with that property. If it is a commercial property, how it gets impacted. So, all these are basically something which gets impacted by these zoning modifications. And then there are a lot of infrastructure developments which constantly takes place in India. So, that can change the transportation dynamics. It can make access to that particular place much better. Utility availability can also be there, that you have proper power supply, water availability in a particular area. And then social infrastructure can also play a crucial role, that if there is some shopping or other amenities which are there, so that can also be very helpful. So, all these things can be taken into account when we are talking about the risk of a particular property. Then we come to demand supply dynamics. So, we can see that we have this particular table. These examples demonstrate the importance of market specific analysis. So, in the residential sector, Mumbai face supply constraints in prime areas due to land scarcity and regulatory complexities. However, key risk factors include affordability challenges as price have outpaced income growth, and potential oversupply in distant suburbs where commuting cost and time may limit demand. Then we have Bengaluru, somewhat balanced market with steady absorption from IT sector growth. The prime risk factor is heavy dependence on technology sector, which creates vulnerability to any significant downturn in IT employment or global technology outsourcing trends. Then we have the NCR region. NCR region is still absorbing historical oversupply from 2012 to 2016 period, leading to selective performance based on project quality and location. Market closer to employment centers are performing better than the peripheral developments. Pune benefits from strong demand along IT corridor. Particularly areas like Hinjewadi and Magarpatta are looking at that. However, infrastructure bottlenecks, especially transportation connectivity, creates risk for projects in emerging areas. Then we have Hyderabad, which faces potential oversupply risk despite strong fundamentals, as multiple large-scale projects have been launched simultaneously in the high-tech city corridors. So, in the commercial office sector, Bengaluru continues to benefit from strong technology sector demand and measured supply growth. Hyderabad shows rapid supply expansion that may outpace absorption despite growing global capacity center demand, and Mumbai maintains limited prime supply with stable occupancy, supporting rental growth but limited investment opportunities. So, these market specific conditions demonstrate why location level analysis is essential. Broad market trends may not reflect conditions in a specific sub-market or property type. So, that may vary. Then we come to location risk analysis framework. So, here location selection represents one of the most critical risk factor in real estate investment. Let us examine a systematic framework for location risk assessment. So, our location risk scoring matrix weighs 6 key factors. We have accessibility, which carries a 25% weight, includes transportation links, road connectivity, and proximity to major employment or commercial centers. In the Indian context, metro connectivity often creates significant premium and reduce location risk. Then we have business ecosystem, receives a 20% weight and examines industry clusters, employment concentration and economic diversity. Areas with single industry dependence like some IT parks carry high risk than economically diverse location. Amenities represent 15% of the location score and include school, hospitals, retail centers and recreational facility. These factors particularly affect residential demand and long-term value retention. Then we have infrastructure, also carries 15% weight, covering power reliability, water availability, telecommunication and sewage systems. In the Indian context, backup power requirements and water scarcity issues can significantly impact operating cost and tenant satisfaction. Then we have growth potential, represents 15% of the score and analyze future development plans. And we have environmental, that factor that receives 10% weight and assess nature hazard exposure, pollution level and climate change vulnerabilities. So, the scoring system ranges from 1 highest risk to 5 lowest risk for each factor. The weighted average provides a standardized locations risk score that can be compared across different investment opportunities and used in portfolio construction decision. So, that is how decision can be taken for location. Then the systematic approach helps us to avoid emotional or relationship based location decisions and create accountability for location selection within investment teams. Then we move to regulatory risk landscape. So, we understand that a lot is dependent on regulation when it comes to real estate. We have been discussing about it. So, now deeply understand that through the prism of risk. So, there can be development regulation modifications, FSI, FAR. We constantly hear about that from Mumbai Builder Lobby. In news, there has been lot of discussion about that. Then we have land use changes, that can be big reason to actually plan the land purchase. And then environmental compliance requirements, coastal zone or not, such type of factors can play a crucial role. We have seen that in Kochi, we have seen that in Mumbai. And then we have talked this tax policy modifications, which basically affect the overall profitability of any investment, and so it will also impact the real estate. Then we have RERA impact. So, RERA has brought in lot of transparency. So, it has reduced risk. The fund diversions, which was typical for real estate, residential real estate, it was very typical. Now, it has changed a lot because of the escrow mechanism. And then approval transparency, all that is there, has reduced the risk. New compliance have been created, registration requirements, escrow mandates, all that. And then approval process challenges, multiple agency coordination, challenging requirements, timeline uncertainties. So, that kind of improvements have been brought about by RERA. Then we have interest rate risk mechanism. So, we have some direct impact because of that. So, financing cost, variable rate loan exposures, something which is definitely related, that the variableness of rate can be there, it gets impacted directly. So, if we see, so that all leverage investments and development projects, it will be impacted. Most Indian real estate debt is variable rate, typically linked to the repo rate plus a spread, creating direct exposure to RBI monetary policy changes. Second, we have cap rate correlation, means when risk-free interest rate rise, property cap rates typically follow through with some lag. Then we have historical analysis that suggests a 100 basis point increase in interest rate typically leads to 25 to 50 basis point increase in property cap rates, depending on market conditions and property type. Third, buyer purchasing power decreases when interest rate rises. So, a 1% increase in mortgage rate typically reduces buyer purchasing power by 9 to 12%. Assuming constant debt service ratios, this affects both sale prices and sale velocity. The Indian context creates additional complexities. So, RBI monetary policy tends to be more volatile than developed central market banks, creating greater interest rate uncertainty. The post 2000 linkage of lending rate to repo rate has increased transmission speed and magnitude. That also is something which is there. And Indian markets also face higher spreads compared to developed markets, and limited availability of long-term fixed rate financing. So, what are the mitigation approaches? So, these markets are still developing in India. Conservative leverage ratios provide natural protection against rate increases. Staggered debt maturities help avoid refinancing concentration during high rate periods. For investment analysis, we have stress testing should include scenarios with 200 to 300 basis point rate increase to ensure projects remain viable under adverse interest rate environment. So, all these things should be taken as mitigation approaches. Then we come to liquidity risk assessment. So, liquidity risk, the possibility that you cannot sell a property quickly at fair market value varies significantly across property types and market condition. Understanding these factors is crucial for portfolio planning and exit strategy development. So, we have property specific factors strongly influencing the liquidity. So, size and specialization creates different buyer pools. A 500 crore office building has fewer potential buyer than a 50 crore building. Location quality affect buyer interest, with prime location typically enjoying better liquidity. Property conditions and needed capital expenditures can delay or complicate sale processes. And then tenant quality and lease terms affect buyer perceptions of investment risk. Then we have market conditions creating cyclical liquidity variations. Transaction volumes provide early indicator of market liquidity. Capital availability from banks, funds and private investors directly affect buyer capability. Overall, investor sentiment influence pricing expectations and transaction timeline. Then we have measuring liquidity risk requires tracking several metrics. So, time on market varies dramatically across property types. Class A office building in Mumbai's Bandra Kurla complex typically sell within 3 to 6 months, while specialized properties may take 12 plus months of marketing. We have bid ask spread indicates market liquidity. So, normal market shows 5 to 8% spread between buyers and sellers expectation, while stress markets can see 15 to 20% spread that prevents transaction completion. And then we have transaction volume. We have transaction volume trends provide early warning indicators of changing liquidity conditions. So, declining volume often precedes price adjustments and increased liquidity risk. Then we also have to look liquidity risk management requires planning during acquisition. So, understanding potential buyer pools, maintaining property conditions and having flexible exit timing can significantly reduce liquidity risk during disposition. Then we come to financing risk and LTV analysis. So, financing risk encompasses both the availability and term of debt financing throughout the investment period. Let us examine how loan to value ratios and financing structures create different risk profile. So, conservative, standard and aggressive LTV threshold vary by property type based on lender risk assessment. So, for grade A lease office building, conservative financing uses less than 50% LTV. Standard financing ranges from 50 to 65 and advance will go for 65, greater than 65%. The higher income stability from quality tenant supports higher leverage levels. Residential development projects face more conservative lending standards due to completion and absorption risk. So, conservative LTV stays below 60%, standard ranges from 60 to 70% and aggressive exceeds 70%. Retail properties face moderate lending standards with conservative LTV below 55%, standard between 55 to 65% and aggressive above 65%. Hospitality, you will see it is very riskier proposition. So, you will see that due to operational volatility and economic sensitivity, we have seen during COVID times how low the levels had gone for hospitality, and from where from that downturn we have seen the boom period now. So, hospitality 45 less than 45% for conservative to greater than 55% for aggressive, but still very low. And then there is upcoming warehousing because of e-commerce, it is gaining quickly. So, that enjoys relatively favorable lending terms. So, due to longer lease terms and growing demand, so it ranges from 60% to 70%. Now, Indian financing environment offers distinct choices. We have banks, we have NBFC, and we have in these two options which anyone can choose from. But we know that NBFC though offer greater flexibility, but they charge higher interest rate, whereas banks, they impose stricter requirement, but they offer lower interest rates. Post-RERA implementation has increased scrutiny of developer sponsors, particularly for residential projects. Lender now require more detailed project approvals and track record verification. So, various type of components of cash flow, revenue risk, expense risk, timing risk, we understand that how they are impacted. So, tenant default can range from temporary payment delay to complete lease failure that we have seen. Then extended vacancy period between tenants create carrying cost burden. And these type of there can be lease incentives such as free rent period or tenant improvement allowances. So, such type of things can be there, and lease incentives, the best is that we have these like specifically if we talk about COVID period, there was free rent periods where tenants, like, because they specifically, if you know that the in the mall there are there are certain restrictions which were imposed at that time, and so there was no point in collecting rents. So, these type of things can happen, and there are dull periods also. Then that time also, like especially in if you talk about educational institutes, the eateries there during vacation time, they may get these type of periods. So, there are such issues which can crop up regarding the revenue. They can become risk for revenue. And then we have expense risk, unexpected maintenance can happen, utility cost can increase, that can lead to the risk, and the tax reassessments can be there, that the tax authorities are coming up with the new assessment. They think that there is a short tax you have paid. So, they may create a tax demand, and all that can also lead to extra expenses. And insurance premiums, particularly after natural disasters, these changes in risk assessment can create ongoing cost pressures. Then timing risk affect both development and stabilized investment projects. Delayed lease-up periods extend stabilization timeline and reduces the early cash flow. Then we have construction delays in development project that affect completion timing and lease commencement, and approval delays can postpone project start or create carrying cost during developments. And then we have analysis techniques which help quantify and manage cash flow risk. Debt service coverage ratio, stress testing examines how various adverse scenarios affect the ability to service debt commitments. And minimum acceptable DSCR, typically it ranges from 1.20 to 1.30 depending on the property type and lender requirement. And then we can also do break-even occupancy analysis to determine the minimum occupancy level required to cover operating expenses and debt service. So, this provide a clear risk matrix. Properties with break-even occupancy level of 85% or higher face significant cash flow risk, while those with break-even levels below 70% have greater downside protection. And then cash flow variability model using historical data helps us to establish realistic projection ranges and identify key drivers. Then we move to environmental compliance landscape. So, environmental compliance has become increasingly complex, and costly in Indian real estate development. So, we have to understand that. So, environmental clearance process apply to larger development projects. Ministry of Environment, Forest and Climate Change requirements apply to project exceeding 20,000 square meters of built up area, and then state environment impact assessment authority approvals are required for medium scale projects, and then these projects typically add 8 to 12 months to project timeline and require specialized consultants and studies. Then ongoing regulatory requirements, consent to establish, operate CT and consent to operate CTO certificates are required before and after construction completion. Waste management compliance include both construction waste disposal and ongoing operational waste management system. Green building mandates are becoming more common in major cities, requiring LEED or similar certificates. And we have energy conservation building code. Compliance is mandatory for commercial buildings exceeding certain size threshold and affect both design and operational requirements. Then we have risk assessment framework that includes 4 key elements. First, regulatory applicability analysis, which requirements apply to specific projects. Second, project classification assessment identifies the approval pathway and timeline requirement. Third, the compliance cost estimate include both direct cost and timeline impacts. And then fourth is your environmental, we have compliance cost that typically range from 2 to 5% of project cost. Fourth is your the enforcement risk evolution that assesses the likelihood and consequence of regulatory violations which have increased significantly with improved monitoring capabilities. Then we have natural disaster risk mapping. So, India's geographic and climate conditions create significant natural disaster risk that must be carefully assessed for real estate investment. So, flood risk affects multiple regions through different mechanism. Coastal areas, we have storm surge vulnerability. River basin, especially in monsoon, some areas flooding can take place. Then in areas which are in zone 4 to 5 of seismic map can have, which is around 59% of land area. So, there is a seismic risk there, possibility of high magnitude earthquake. So, Delhi NCR, western northern region are high risk because of that. In Bhuj 2001, there was 10,000 plus crores damage of property, and these kind of events can happen, and once in a lifetime events they can be, but they can be very, very disastrous, and that is why proper risk mapping has to be done for them. Then we have cyclone risk in East Coast, we have Bay of Bengal systems, in West Coast we have Arabian Sea exposure, and coastal development particularly is vulnerable. So, we also have coastal zones which are being followed, whether it is your Kerala or Mumbai. So, we often hear projects being affected by the coastal zone, the regulations there. And we have assessment methodology. So, historical event analysis, we have hazard mapping and modeling, vulnerability assessments can be done, and then probable maximum loss calculations. So, these can be used in a computer model, and then on the basis of that risk mapping can be done for such natural disasters also. Then we have climate change implications. Now, that is something which can also be taken into account, which should be taken into account. So, long term climate risk. So, we have physical risk of sea level rising. We have seen that this phenomena has been observed in various coastal cities. So, there has to be assessment of that. Then changing precipitation patterns, this can lead to the kind of risk in the weather, the rainfall pattern, and that must be taken into account. Then temperature extremes, that can also play a crucial role. So, that has to be taken care of, especially like for example, there have been cases where in hilly areas also people are using fan or ACs during summer times now, which was not visible earlier. And then increased storm intensity, these type of cyclones and storms can also impact. So, these type of events can lead to physical risk and they must be taken into account. Then there can be transition risk of energy efficiency mandates, which are being brought in by the authorities. Then carbon taxation potential is also there. So, carbon credits and all that comes into picture, and market preference also constantly shifts. So, that is something which has to be looked into. And also with all this we have technology obsolescence which can be impacting the overall scenario due to climate change. And then risk management approaches which can be employed here. So, climate scenario analysis can be done to gauge or gauge like what are the current climate scenarios, how they are developing, and then adaptation of cost benefit analysis to all that. And then resilient design implementation. So, we are looking at green building design being implemented more and more because of all these reasons. And then carbon transition planning can also be done, so that such material can be used where you are having this we have curtailed this issue, and we can plan accordingly for it. Then infrastructure dependency assessment. So, critical infrastructure systems, we have transportation. So, we have road network connectivity, we have mass transit access. So, metro we talked about, and then last mile solutions also. In case of metro, there should be connecting something, some kind of transportation should be available from metro station to the office. So, these are your critical infrastructure transportation related points. And then utility, we have power reliability. So, for example, Chennai 100% backup typical is required, is there. And then we have water availability, pressure. So, we recently have in news it was discussed that Bengaluru was facing water crisis. So, planning has to be done for this also. And then sewage treatment capacity should also be there. So, that is something being looked about by different commercial projects, specifically REIT and such listed players often talk about the sewage treatment plants which they have employed. And then we have digital, we have fiber connectivity which we have to look into, mobile network coverage. This is something which we have improved a lot in India. And then data center proximity is also now gaining prominence. Then we have to look into risk mitigation to all this. So, private infrastructure development, where we can actually use say solar panels, and we can employ sewage treatment plant. So, redundancy planning can also be there, that that may also be very useful. And we can have technological solutions to all these problems. So, that we can look at. So, and the public private partnership also. So, for example, redundancy planning ensures your backup system for critical infrastructure. Technological solution will include smart building systems and energy management that can optimize infrastructure efficiency. And public private partnership often provide infrastructure solution that benefit multiple developments within an area and potentially reducing individual project infrastructure burdens. Then sensitivity analysis fundamentals. So, we can step by step we can see. One, this involves identifying key variables that materially affect investment returns. We have revenue factors including base rents, rental growth rate, and stabilized occupancy levels. We have cost factors encompassing construction cost, operating expenses, and capital expenditure requirements. Then we have exit assumptions. So, that include terminal cap rates and disposition cost. and financing term covers interest rate, loan to value ratio and amortization periods. Then step 2 would be define appropriate test ranges for each variable. Typically practice use plus or minus 5 to 15% variation from base case assumption. These ranges should reflect historical volatility and current market uncertainties. For example, construction cost variation might test plus or minus 10% based on recent material cost volatility, while rental growth rates might test plus or minus 5% based on historical market cycles. Step 3 will be calculate calculates impact by changing one variable at a time while holding all other assumptions constant. So, this isolates the effect of each individual variable on key metrics like IRR and NPV. The analysis measures both upside and downside sensitivity to understand the asymmetric impact. And step 4 creates tornado charts that rank variables by their impact magnitude and visualize relative importance. So, variable with greater impact on return deserves the most attention during due diligence and ongoing asset management. So, the key benefit of sensitivity analysis is identifying which assumption most critically affect the investment success. So, this helps focus due diligence efforts and ongoing monitoring on the variable that matter most. So, it also helps investor understand which external factor they should track most carefully during the investment period. But there are certain limitations. So, limitations include the assumption that variable change independently, which may not reflect reality during economic cycles when multiple negative factors often occur simultaneously. Then let us take one example. So, this example demonstrates both the methodology and insights that can be gained. Our base case assumes 15% IRR for this office building investment. Now, let us examine how changes in key variable affect this return. So, market rent shows significant impact on returns. A 10% decrease in market rent reduces IRR to 11.3%, while a 10% decrease in market rent reduces IRR to 11. While a 10% increase raises to IRR to 18.5%. Then we have the 7.2 percent range that demonstrates substantial rate sensitivity. So, this way we can see that we are looking at the rate sensitivity. Then we have exit cap rate, a 10% decrease there, how will that impact, and this then 5 then we have the occupancy rate that show moderate sensitivity. So, that will be there, and then operating expenses that show relatively low sensitivity. So, this kind of analysis we will do, and from this analysis we can help prioritize management attention and due diligence efforts on the factor that most influence the investment success. Then we go for the scenario analysis framework. So, we have base case most likely outcome, upside case favorable condition, downside case unfavorable condition, stress case severe adverse conditions. So, these are some scenario we will make, and then development process we will create coherent narrative for each scenario, ensure internal consistency across variables and assign probable weight, that might be optional, but we can do that also, and then calculate the performance metrics for each scenario. The benefit we will get is that test combined effect of multiple variables changing simultaneously. So, this type of analysis we can do. So, this is how it can be done for sale price, upside base, downside absorption we can do for construction cost. So, this is how the overall process will look like. So, this is from one project, but this type of analysis you just example of it, that they can also be done for other type of project. What is the upside, base, downside, stress we can calculate. So, this way we can create a overall scenario. Then we have Monte Carlo simulation basics. So, we have advanced probabilistic modeling, which variables define as probability distribution, not single values, random sampling across thousands of iteration, and output probability distribution outcomes. So, this kind of Monte Carlo simulation, you can create a simulating environment and you can do this. So, let us basically look at it. So, in here input variables are defined as probability distribution, market rental growth used as a triangular distribution. So, all these are basically coming up at a creating a probability situation, probabilistic modeling. That is what we are trying to do through Monte Carlo simulation basics, simulation technique. So, this is the thing. This is one example of Monte Carlo simulation, where we have market rental growth, we are taking triangular, vacancy rate, exit rate, and then we are coming with the output statistics. So, this is this is how this simulation can be done, and we can analyze the situation. Then we go towards risk adjusted return measure. We have Sharpe ratio, we have Trainer ratio, we have Sortino ratio, and we have seen Sharpe ratio and Sortino ratio. And Trainer ratio, basically you have expected return minus risk free rate divided by beta, which is your adjust for systematic market risk. So, this is one example of Mumbai grade office. So, we have IRR, we have standard deviation, we can calculate the Sharpe ratio of these, and we can see that even though that some of them are making more return, but when we make the Sharpe ratio, it might not look that well, that good. So, this is basically how the comparison can be done using these. Then break even analysis, we know that when we will minimum performance need to meet return targets, and we can do this kind of analysis. We have a formula of operating expense plus debt service divided by gross potential revenue. And diversification strategies. So, we have tier 1 cities of 60 to 70% geographical diversification. So, this is your portfolio risk reduction through diversification we can do. So, we are distributing in different geographies, we are distributing in different types, commercial, office, residential, we are making a mix of that, and we will try to have lower correlation between the asset classes. So, the greater risk reduction we can achieve. So, that is what diversification strategies we will try to use. Then contractual risk allocation. So, we will have purchase agreement, development contracts. So, these are the different types of we can do. So, we can have risk allocation properly done. For these we have different type of lease structures, whether it is triple net provision, escalation clauses, and security deposits. So, they have different mechanisms can be used, and the contractual risk contract can be used for proper risk allocation between the parties. Then insurance and hedging solutions, that can be there, that traditional property coverage be risk transferred to third party. So, here we have to this is something which we can use, whether we can use insurance, we can use hedging, financial hedging, interest rate caps, currency forward for future current for foreign currency also we can use. So, these type of methods we can use, and we can have a due diligence framework like this: core due diligence areas, legal and titles, Indian context challenges, and then strategic exit planning. We can also think of target holding period aligned with market cycle, outright sales. So, basically exit alternatives we can think of. So, optimizing the investment disposition. So, we can do these strategically and plan for them. Case study, these type of situations can be looked at through phase development in financial hedging and all that. So, the holistic approach is required. We require risk return optimization. We go for Indian market context, we have to see what is fitting India and what is not, and we have to remember that it is evolving landscape. Thank you so much.